Elliot, how are you doing, sir?
I'm doing well. How are you?
I am doing good. This is going to be fun. We were just talking about how we have a lot of common connections. I saw you, my friend Walker Dybel interviewed you. You've been on
Yes.
Bigger Pockets podcast, and we had a good friend Tyler introduce us. And
Yes.
we are in the world of buying and selling companies, and you're at the nucleus, which is the funnest part. There's no real challenges in due diligence. It's all easy
Yeah.
peasy.
Yeah. Simple. It's like
Simple,
one,
right?
two, three.
Yeah,
Even
you
now.
know. Yeah, there's no need for a deal room or a vault or like documents or anything like that, right?
Nothing. And you can trust everybody. They're all professionals, lawyers, accountants, buyers, and sellers. They're all
Everybody
like
knows exactly what everybody's doing. It's super coordinated, right?
efficient markets. Information is shared completely between all parties. It's 100% known.
So before we get into how everything we just said is complete BS, and we're
Right.
going to unpack what really matters, why don't you give the listeners a little bit of a backdrop of your journey, how you got to where you are, because it's a pretty interesting ride that I've just observed online as I was doing some digging in, but I'd love to hear it.
Yeah. So I love the phrase "I got it honestly." So both my parents were CPAs and financial consultants. So I decided to go a different route, engineering out of undergrad, but then found myself in sort of strategy consulting. Got into Harvard Business School, and then a mentor kind of introduced me to private equity. And so I quit my job early, worked at a search fund doing an acquisition screen, used that as sort of a hunting license at HBS during a tumultuous time. It was right after Bear Stearns and Lehman Brothers fell. So like, if
Oof.
you can even imagine the finance talent in my class, I was like number 376 in the private equity line, and I just out hustled everybody. So I landed an internship at a private equity firm here in Atlanta, and then leveraged that to get a full-time job in Boston at a group called the Watermill Group. Amazing sort of family office, private equity group that's been around for a very long time, focused on industrials, just great folks. And so my whole life was in Atlanta though. So I just finished the best business school in the world, and I'm a 2.5 hour flight, almost 3 hour flight from everything I love in Atlanta. And so I made the decision to come back, and that was the impetus I needed to start being entrepreneurial. So I started a independent sponsor private equity firm with a mentor, Ellsworth Partners. We looked at deals $2 to $8 million in EBITDA, primarily sellers retiring, a lot of broker deals, some proprietary ones as well, value buys, finding companies that had issues with concentration or sort of geographical limitations and kind of structuring deals around that. A couple years into that, my business partner effectively retired, which it kind of stunk for me, but like I love the fact that he retired. Like that's what we all want to do. Like, those guys that are still in the game, like in the hospital bed heading out, and you're kind of like, that wasn't really the example I wanted. So I guess I did have a mentor, and he did do a thing. So I rolled out and did my own private equity independent sponsor firm called Spartan Capital. I looked at deals about the same size. And around 2017, I changed my model. And I knew that it was very tough to find advisors in the lower middle market. I knew that very few people knew how to do deals under $3 million in EBITDA with any sort of quality. People were scared of them. I knew that, hundreds of thousands, I don't know what the numbers are, but all the baby boomers that are retiring, the numbers of these businesses that will trade hands is enormous. And I felt there was a need for a sort of boutique buy-side M&A advisory firm to help family offices, independent sponsors, and acquisition entrepreneurs execute deals, primarily focusing on due diligence for now, but sort of expanding to a full suite of buy-side M&A services. So that's, in a nutshell, my path. Really,
And
really
no
straight.
challenges along the way, just smooth
No.
sailing. You got so I'll cut the
Easy,
sarcasm. Yeah,
easy peasy.
yeah,
Yes.
and show's
Easy
over.
like 2020.
Yeah, yeah, show's over, folks. No. So, Elliot, there's a bunch of things that you've already touched on that I'd love to unpack a little bit, and then And then we can dive into a lot of the stuff that you're seeing on the buy side, and we can just take this wherever you want to go. But so in the show and the online course and boot camp that in-person boot camp that we teach, we talk about the three different in principle 3, we talk about the 5 major exit options, and we just bucketed them into 5 big buckets, Elliot.
Yep.
Internal, ESOPs, private equity, strategic, and acquisition entrepreneur. And you touched on private equity, family office, and you talk about independent sponsor. So maybe just in your definition, you can kind of break down the overall differences from your vocabulary of private equity, family office, and independent sponsor.
Yep. So private equity is what I call institutional capital, meaning people have raised money from pension funds. The biggest pots of money in the nation/world are the investors in private equity funds. They're typically, 20 million, 50 million, 100 million, $1 billion, huge. And they hire the absolute best talent from Wall Street, top 3 business schools to help them buy companies. They have committed capital sitting, waiting for them to invest. And they are the most sort of active, hungry sort of buyers that are out there. They make a lot of money and they're really good at what they do. Family offices also buy companies, but family offices are typically someone in the lineage of a family sold a business most often, or has sort of built up enough money where there's a real job to invest the money of that family. And that's a family office. But it can be as big as like the Rockefellers or the Carnegie's family office, Zuckerberg's family office. But it could also be, 10 manufacturing company owners that sold last generation in your town.
Mm-hmm.
And then an independent sponsor is typically it's a trained professional who understands deals, may have worked at a private equity firm, mezzanine shop, corporate development, something of that nature, that now is endeavoring to go find companies for sale and sort of raise capital deal by deal. And so that's how I separate those 3.
And then so your independent sponsor, like the acquisition entrepreneur and the buy then build, like Walker Dybel kind of thought process.
So yes, the 4th. And I separate it this way. I think in general, and this is not exact because I talked to a lot of independent sponsors and acquisition entrepreneurs. I talked to one this morning that was an HBS alum, so clearly not lack of experience, but generally the acquisition entrepreneur is probably on average more of a mid-career person who, Walker Dybel reads his book, or there's a bunch of classes, Carl Allen, Roland Frazier, he might take something like that, or just kind of is tired of the rat race and says, I think I can buy a business and I'd rather do that than work a job. And so there's typically a difference of familiarity and history with the deal process between those 2 entities.
Mm-hmm. It's a really good way to break it down. And even with the family offices, like a family office could invest in a private equity firm, part of their portfolio, or they could just buy the company and skip the general partner, right? I mean, so there's different ways. And I think, the reason I wanted to set that groundwork, Elliot, is because everybody wants something different with a deal. And I'm just gonna I want to throw this one concept across, and then I want to get into how, when you're on the buy side, the purpose of the deal is going to be different and how that's going to impact the purchase price, the deal structure. And I think a lot of the stuff that you've got a lot of experience in, and then how that is also then reflected in due diligence. But so this concept is, Elliot, and I'd love to hear your thoughts on it, is we break out valuations because entrepreneurs get so freaking confused. And it's like, what the reality is, the value of your business, the multiple is going to be applied to your EBITDA, but it's just going to be based on the risk of your cash flow, the future risk. Right. Discounted cash flow, or just the intrinsic financial valuation is based on the risk of your cash flow. And then what I like to say is, then there's this other transaction value that is the buyer and the seller, and then there's the purpose of the deal. So you could have it, but it starts at the financial valuation. It's not some mystical, thing that's grabbed out of thin air. It starts at this risk of the cash flow, the intrinsic value. And then you might pay a premium because the buyer needs a customer base, a location or something, or you might even discount it for estate planning purposes. Yes. But it starts with the financial valuation.
Yes, absolutely. That's it. And valuation on the lower middle market, kind of, I call it Main Street Plus sometimes.
Plus, that's awesome.
It's an art and a science. I can tell you the multiples on 35 different industries based on 10 years of looking at thousands of deals, right? I could also do a DCF for each one to be more accurate. I could also tell you, on deals under, 2 million, definitely under 1 million, you're probably paying 3 to 6 times.
Yeah,
and
exactly. Yeah, a little bit more frothy in your neck of the woods. No.
Yeah, and the market, at times, if you're look, I told people all the time I don't know how to spell six, but people are paying those things, and I like your concept because that's where you start. And then I think the added thing I would toss in there is also structure. So you could pay more, pay less, and then you could pay it at close or over time. And those are all ways to adjust the fundamental value of the business based on the consistency of the cash flows. But there's also risk sharing, right? I think that's the piece that may have been missing. And it's funny, my friends have over time called me a risk mitigator, which I think I got that honestly too, but sort of you're essentially transferring, say the deal is a $5 million deal, you're transferring $5 million of risk from the owner to the buyer in this purchase agreement document that's going to write up the terms of how that's going to happen and in the pricing structure of the deal. So, as the owner, day before deal, you own the $5 million of risk because if all your customers leave, you don't have $5 million. You sell that business, now that buyer is holding that $5 million risk.
So let's take this in those layers and unpack this, because where we're going to end up is in the due diligence process and like things to look for, things to help prep even years in advance, because this is not about selling, it's about being ready and or buying, because a lot of people, to get to the enterprise value that they eventually want, might have to go acquire. And so, right. But just in going back to your concept, Elliot, is you got enterprise value, the purchase price. Mm-hmm. Right. And then there's the purpose of the deal, which based on the 3-4 buyers that you talked about or you represent, the purpose of the deal is going to be completely different. So yes. I'd like to take the purpose of the deal and kind of walk through the different buyers and how that works. And then also when you talked about sharing risk, and I think this is a great topic for today's episode, is that you can get to the enterprise value, which is that purchase price. But if I said to you, I'm going to buy your company for $5 million and it's going to be over 100 years at negative interest rate, like, okay. So that's not, that's sharing risk the other direction. So maybe and that's deal structure. And we get into due diligence and how due diligence might impact the deal structure. So maybe just talk about the purpose of the deal first.
So
why are people buying companies? Yeah.
Well, so for private equity, it's because you have to put money to work, and that's the asset class you chose to invest in. And so you signed up. I am a private equity investor from $2 to $10 million in EBITDA in these 3 industries. I don't do stuff outside of that. That's what I do. I want to beat everybody else at doing it. That's what you do. If you are a family office, you have an allocation of capital. So every $100, 50 to 70 will be in public market stocks, 10 to 20 will be in real estate. The rest will be in alternatives. Like you said, alternatives will include, I might be a family office and invest in private equity fund. I may invest in an independent sponsor. I may invest in a company directly. The purpose would be to a couple of things. So the purpose in the family office is probably the most wide, which is just a function of sort of, you think about the complexities of a family. It can be to absolute return can be part of it. It can also be around generational wealth transfer. So the second or third generation may need a business to run that may be different than the business that was sold. So that may be it. The other thing may be, a lot of family offices have done great in public markets, great in real estate, and now they want to venture out into private equity. And so they may do a deal to kind of train themselves and whatnot. So those are sort of popular purposes for family offices. Independent sponsors are typically lean, mean deal executing machines. They've sort of learned how to consummate deals and feel confident enough to both raise capital and due diligence simultaneously. So they have large capital relationships. They're looking for maximum return as well, but typically, I would say, subject to their own personal constraints, right? So these are people that are putting money into deals, they haven't like raised their hand like in the same way. Like I do deals $2 to $10 million. I want to
keeping
be
it a little open, right?
yeah, which is great. And then acquisition entrepreneurs are oftentimes sort of aspiring independent sponsors to an extent, right? People who are sort of buying one company to see if this is better than the alternative and looking to figure it out. So for them, it's typically either the same return purpose or to create an alternative to their job. So a lot of the folks, if you looked at their LinkedIn, they're still marketing execs or, regular
Running a
guys,
P&L somewhere.
Yep.
Yeah. It's interesting too, is like, I mean, so is your definition of an independent sponsor versus an acquisition entrepreneur is more like they're going to probably stay underneath the 5 million enterprise because they can use an SBA loan, maybe some of their 401k or, anywhere 2 to 500 grand to buy a company.
Right.
Yeah. Versus like, hey, I need a big pool of equity.
Yes.
Let's go buy a deal.
Another great delineation is the size. So like 90% of the acquisition entrepreneurs are looking for things that's SBA loan. Independent sponsors are typically larger, but you're seeing a lot of overlap, man. I think in the current marketplace, what I love is that the lines of demarcation are sort of almost like creeping out like Homer Simpson into the bush. Because at the end of the day, everybody wants maximum return on the amount of money they're willing to allocate to this particular endeavor. And so whatever mechanism gives them that, subject to their personal constraints, financial constraints, and sort of risk appetite, that's where they're going to go. And I think people are seeing that, Wall Street will convince you that the only thing that matters is the biggest thing you can do. And I think people are sort of bucking the system on that and saying, no, I think a big thing may be just as troublesome as this job that I have. I might want a smaller thing for a lifestyle business.
Oh, I mean, Elliot, the things I totally agree with everything you said. And like the other variables that are playing into this that I'm seeing, I got clients and people that I know that are getting insane, like 20, $30 million all cash offers from private equity firms. And I'm watching it, the big put, these are institutional investors that promise a 20% internal rate of return from the pension funds that are already overextended. And so everybody's in this chasing the returns.
Yes.
And then you got the Federal Reserve that said, hey, by the way, 0% interest rates for the next 4 years or whatever. And it's like,
you could not have presented that physically any better. I just got off a call about this. It's like a person wants to jump out of like a private equity firm to then go chase private equity returns as an independent private equity guy. And I'm not saying anything about that choice because I made it myself, right? So if anything, I'm laughing or sort of critiquing my own choices. But the reality is like, there's like in the game stuff, like 24/7, like when you're a private equity person, they're paying you $250,000 and up, you pick up your phone when the MD calls, right? like wherever you are.
Yeah, like you pick up the phone, period.
You pick up the phone. And look, I think we're all balancing where we want to be money-wise versus life-wise. I think it's a beautiful thing as this industry matures. It's also sort of like a democratization of private equity, right? Because it used to be the only way you learn is sort of going and apprenticing under someone that's done it. I still think that may be the best way, but there's other ways to get pieces of this. And I think there's way more opportunity. There's way more sellers than qualified buyers.
Interesting that you say that. And I also it's funny because I also see, I think there's just a limited amount of qualified buyers and qualified sellers. So then you have this like completely inefficient marketplace, which is the opposite of what we all believe. Because you say, okay, well, you know nothing about selling a business and you know nothing about buying a business. How about we just facilitate an SBA loan for everybody? And then you're just like,
and then get married in 90 days.
Yep. Yeah. Actually, isn't there like some stupid show online where like you just get married on the first date? And that's essentially what it is. And so and I think going back to why we like laughing around about this, if people aren't familiar with this world, is because the purpose of the deal and people's motives are driving all this, right? So the desire for yield and the return for investors, and then for the general partners of private equity firms, like Elliot, I've said like you couldn't pay me to have $100 million fund right now that I need to spend because I would have to buy what, 300 to $500 million of enterprise value. And I'm going, where the
Yes.
hell would you find that?
Yeah. And if you found it, look, again, when you owe people $100 million, you have a lot of people you have to pick up the phone for, right?
Yeah.
You have a lot of people that come in town for a dinner that you have to go to. And so it's daunting. And look, some people have the heart for it, some people don't. I mean, I am not a fun guy, but I didn't come out of the fun world, right? So I came out of places, independent sponsor shops and family offices. And so they showed a different kind of sort of investment orientation. It's almost like if you think about Wall Street versus like going to see the greatest show on earth down there in Omaha and watching Charlie and Warren berate all of the Wall Street and San Francisco people, and then they get back on planes and fly home. They're all wicked smart, right? Let's not be stupid. And they're all very hard workers. It's just like the orientation towards it feels different.
Well, and it's interesting too. And like you said, like, it's not that it's things are good or bad. It's just watching the signals of what's going on. And like, so like, even because I think this will tie in nicely as where we're going down your journey of your expertise and things you see is that, so like when you hear these all cash offers from private equity firms on insane multiples,
Right.
you're going, okay, these general partners are overpaying for these companies because they need to buy something in order to invest. So they're
Right.
overpaying.
Right.
And then they're giving all cash. So the risk
Right.
is they're assuming more and more risk as the investors,
Yes.
which is just going to, it's okay for the sellers if you're getting that, but what might happen afterwards is something just to be wary of, because you're just like,
yeah,
we're not on video, but your face was like all telling, right?
Yeah, no, I wish people could see the face. I think you're going to exchange the tape, so maybe they'll see it on my side if not yours. But so the thing that you would say, absolutely, the way that those buyer types treat your company in general will be very different. If I'm talking to the buyers, or sorry, the owners, the sellers in the space, it's like, because of the motivations, you asked it very well, because of the purpose of the acquisition, the action post-close sort of go along with that. Experience doing it, willingness to do it, impetus to do it, and you have to sort of understand that. I remember I summered at Links Partners here, and 200, probably $400 million now, industrial private equity fund, and I saw the owner of this waste hauling company that hauled waste from, like, there's these intermediary centers in big cities that hold the trash for a little bit and they take it way out to the landfills.
Mm-hmm.
And he ran from the intermediary places to the landfills. And he sold his business for like 96. Well, Link sold the business for 96 whatever million. And he went to like Kinderhook, I think, bought them. And you look at this guy, he's in the seat, he's like happy, but that dude is like, he's practicing to run another marathon. Then that business got sold again. And it's just like, you have to know you're running. You know what I mean?
Mm-hmm.
An independent sponsor is not going to have the same staff. And so as a result, oftentimes the changes that they're willing to have time to make are going to be different and oftentimes less.
It's the purpose of the deal. And every single one of those categories that you bring up, you could have a list of 10 people inside of private equity or independent sponsors or family offices, and they're all different. Yes. Every one of them is different.
Oh, yes. Yes. And I'm a diligence person. So we started the call off with this, as funny as getting in here. So finance, particularly alternative investments, particularly direct deals, it's really what I would call like a barbaric sport. Like, everyone has sharp elbows, whether they show them to you or not. If somebody is willing and able to put $1 million, $10 million, $100 million to work, you should believe they have had all kinds of tough conversations and are master negotiators most times. And so what ends up happening, you look at a bunch of different sites that all say, hey, I'm nice, I'm interested in this, I'm seller friendly, I'm all these things. And I think we all market ourselves as certain things. I think for the owners here, you have to really watch the actions of the people you're dealing with to get a sense on who they're going to be when it matters even more.
So one of those actions that you can observe is due diligence, right?
Yes,
Which again, like we started off with, it's just easy peasy. So,
yes,
you know, one thing that like, you know, as we teach this stuff in our training, Elliot, it's like these concepts again, just to constantly reiterate is we got enterprise value, which is that purchase price, right?
hmm
Whether it
hmm
starts from the discounted cash flow and then it has a premium or not, whatever. So you have this valuation with a
right,
multiple. Then you say, okay, then there's equity value after you pay off your debt, keep your cash.
yes,
So
yes,
well, let's again, enterprise, then equity. Then
yes,
we have this beautiful thing called net proceeds, which is what is after you get all your money from every part of the deal structure. So just because someone says, Elliot, you know, I'm going to send you, like, you know, we talk about all these PE firms or independent sponsors, thousands and thousands of people that are direct mailing or telemarketing these owners, trying to get them to sell,
yep,
circumvent
yep,
a investment banker or broker because they don't want to overpay. Right. So
yes, yep.
then you're going to get into this, hey, I'm going to give you 10 million bucks, but that doesn't mean you're getting 10 million all cash. So maybe take it from there and say, okay, what is the process? And when someone's bringing you involved, they start to see Elliot. Now what happens?
So let's start from acquisition entrepreneurs because we're doing a lot of Guardian to focus a lot of our new services and our business around kind of helping those folks, kind of bridging them from the Walker Diaper class to sort of deal execution, which is sort of the playground that we play in and dominate, in my opinion. And so it starts. Well, people oftentimes use us to help sort of negotiate. Understand the auctions they're in, understand the sort of psychology of sellers, and so we're oftentimes sort of on retainer from people. But the real show starts at the letter of intent, and that's the other side of valuation. So you get a valuation, say it's $1 million company, and somebody's paying $4 million for it. As soon as I get to that number, I put that number in a letter of intent, which says, "Hey, I'm going to pay you $4 million. Here's how I'm going to pay it, and here's our exclusivity, how long I have the exclusive right to buy your business. Here's when I'm closing, and here's my expectations during diligence." And now the game starts.
I like, you know, you get this smirk on your face because you're on the buy side, right? And so what
Yes.
I've heard, I'm for some reason feeling super sarcastic today. So like for what I've heard constantly in my own experience, that the deal price always goes up after due diligence.
Oh, yes, absolutely. Dude, we should just end the whole podcast there. Exclamation point,
Yeah.
in parentheses, psych.
Oh my
So,
God. And the reason I did just say that is there was like, I mean, the amount of times, I mean, it's every week, Elliot. Hey, Ryan, been listening to your podcast for years, or there's someone like in our groups and just great people that, hey, I got this LOI. And I'm like, did you sign it? Yeah. I'm like, well, just that's it. There's no reason to talk to anybody anymore because like you've signed it.
yeah,
The deal train's going.
yeah, yeah. You're on, and keep in mind, I feel that you're representing sellers and I more represent buyers. And typically there's like this huge tension in between the two. But I've started my own business several times. So I've sat in both seats. So although my primary seat is on the buy side now, I've sat in the other seat owning a company and raising capital. So it's not like this shark in the water looking at these fish. It's that this is the game. So I talk to people a lot about the pain the seller takes during diligence, right, is the additional cost they have to endure to sell their business. And that's just it. The reality is if somebody's bringing $4 million in duffel bags to your house, yes, you have to endure some pain to get there. And that's just that. I think a lot of people do use diligence as a way to ratchet down pricing. And I think
Yeah.
that goes back into diligencing your buyers and seeing if they are who they say they are, and are other people who have dealt with them, do they concur? But the other reality is if your business is clean, you kept good books, I'm not saying perfect, I'm just saying almost like good plus, because the businesses here typically, look, private business owners, there's going to be personal expenses, there's going to be stuff in there. That doesn't negate consistent cash flow. It's just, do you have a system of controls in this business from a financial perspective that I can trust? Do you have bank statements, financials, taxes back? are the stories that you need to tell about things that are odd, reasonable. And for me, a big piece is how quickly I get data.
Yep.
It's one of those muscle memories. When I get data slow, I know it's bad.
Like, oh man, you hit on so many things. So let's talk about, with the LOI, because what I've said countless times, and actually even before the LOI, Elliot just mentioned, and on like you said, like the shark in the water and buyers and sellers, and you're so right. And like I say that tongue in cheek because like the reality is a lot of buyers will be sellers and sellers will be
Yes.
buyers, and like a lot of people when they learn the stuff in our training, they're like, well, I should just go use this to buy companies until I eventually sell. And I'm like, well, yeah, of course, because now you understand the real game, right?
Right.
It's the matrix, the zeros and ones. Now you finally get it. So like when you get the LOI, the deal train's going. And so now let's say in that LOI, let's just take a $10 million enterprise
Sure.
value. You say, okay, whatever the multiple is going to be, maybe we make up an EBITDA number of $2 million.
Sure.
So you say, okay, that's what you put in the LOI. And explain like why you hold true that it's not going up. Like you put your expectations in there. So when people, the worst thing you can do is sign one and then say, what should I do now? And it's just, I see it every day.
So the way I respond to that is twofold. The first, a little off. The second, spot on to what you said. So the other thing about buyers and sellers and why there's a really good counterbalance is that if I'm the buyer and I egregiously upset the seller, I absolutely need the seller for a period of 1 to 2 years after the acquisition. And as much as an employment agreement of, $250,000 might sound like a lot of money, if I just gave him 10 million bucks, he doesn't have to show up for $250,000. And so another mitigant for that tension is that what you want, it's going to be a good negotiation, right? We're going to both sort of feel like we could have got a little bit more, but we need to work together because even at closing, the seller's going to know the business 10 times better than the buyer. And so you need that person to be on your side. Now I'll go to your diligence question or LOI question. So you put 10 million in the LOI, but I might say, look, I need a seller note of 2 million or seller rollover of 2 million. I'm going to hold $1 million in escrow to make sure all these promises that you're going to make in the purchase agreement are true. And so what you should expect is the 10 minus the 2 of sort of some sort of seller financing minus the 1 of escrow. So now you're going to get $7 million of cash at close and $3 million are going to come at some period that we're going to define probably in the purchase agreement. And so your letter of intent says that. The other thing is, to your point, why you shouldn't sign it and then call Ryan and say, hey, what do I do now? Is that there's certain parts of the letter of intent that are binding. So for instance, if you accept offer A for 10 million bucks, and then a week later offer B comes for 11, you're going to, I'm tearing this letter up and selling to the guy that's bringing 11. Well, you legally can't do that. You can wait it out for 90 days. You can try to get the buyer to get out of the letter, but they have no incentives to. And so you really want to make sure that you're comfortable. Here's the other thing. Because of that 90-day exclusivity and also the signal it gives to the market, particularly if the same intermediary is representing it, if you find that like a company has been to the altar 3 or 4 times and hasn't consummated, and the broker calls me with that deal, A, I know the seller has deal fatigue. B, there's something in there where that dog's not hunting. And so the valuation to me might go from 10 to now 9, because I just know there's $1 million of stuff in there.
Stuff, just you name it, junk drawer, right?
Yeah. And so that's the letter of intent. Really, if I had 30 seconds to look at it when I do quick reviews, price, structure, exclusivity, and what is the valuation based on working capital. To me, those are the main things.
And I think just, where the LOI and whatever process the seller is using and or on the buyer side, right? Like it's all like, again, we're talking about 2 sides of the same coin. If you like on the $10 million deal, let's take, so you got $1 million or $2 million seller note. A seller note is that 10-year seller note, or is it a 2-year? Is it a 10%
Right.
interest rate, or is it a 2% interest rate?
Yes.
And then
Have I defined any of that at all?
yeah, I mean, or how much is an employment contract versus an earnout versus like escrow?
Do I get
So
my
much.
earnout if I'm no longer an employee?
Yeah. So like the reason I bring that up is like, if you get a random LOI from a random buyer, which is good for the buyer, but the point is to have two parties that exchange a good value back and forth. And like,
Yes.
so like if you have this, $10 million purchase price, you could have 3 deals that all have a $10 million purchase price, but completely different deal structures. So if you if you don't have a controlled auction to sell it, you're going to
Right.
have no idea how to compare a $10 million deal. And then if you're the buyer, maybe explain on the buy side because that's where you're residing most of the time, is how the discussions happen, Elliot, of how you're presenting those deal structures compared to others in the competition, whether you're in competition or you're not, how that impacts what you're doing.
Sure. So a couple of things come to play specifically if you're structuring a deal should sort of be an ideal structure for this given transaction. So if I'm a buyer, the first thing I'm looking at is how am I going to finance this deal? And so when we talk about a $2 million EBITDA going at 5 times, so for $10 million, I know that I'm probably going to get between 2 and 3 times in mezzanine debt, best case. So there's $6 million that I can get in debt. If I want to invest $1 million, so 6 plus 1, I'm at 7. So unless I want to put more equity in, $7 million is the maximum cash that I can deliver at closing, which means I have a $3 million hole that typically is going to get filled with seller financing. That's probably the simplest. I could go on all kinds of permutations of that. The other thing that comes into play, okay, so that's
I think it's huge.
buyer-centric structuring. There's also deal-centric structuring, meaning this $10 million company has 60% customer concentration. And although the seller wants to offload that risk to me at close, I don't want to take it. And so I'm going to peg the EBITDA at blah. And as long as the customer sticks around for 12 or 18 months, then I'm going to pay out the money towards the 10 million. If that customer goes, I'm probably bankrupt, and then that money's not going to get paid. But that's that risk sharing of that's in a situation where there's concentration. And there's tens of other situations where you need to structure around a particular thing.
I absolutely love how you just put that. Buyer-centric structures versus deal-centric, and they're both in play at the same time. So technically, if you think about, like, if you don't have a controlled auction, so if you're selling to a third party, you're the seller, and you don't have 10 options, you don't have any of these. You just have one person that's got their own personal buyer-centric scenarios, and your company and the risk of your cash flow that all get put together. And it's your job to assess the risk, right? I mean, like, that's so you're assessing the purchase price and the deal structure. How do you balance those two, Elliot? So if you're saying, okay, risk at the cash, we're going back to the $10 million. Let's say it's $2 million in EBITDA, $10 million enterprise. You and I both know that that's a very conservative purchase price at this point. It might be more like 20 million because of the deals.
Exactly. And if it's in San Francisco, 50, but yeah.
Oh, you don't even need to make any money if you're in California.
No, we're going off of revenue, guys.
Yeah, pre-revenue. No. Oh yeah. So it's blending the two of, like, okay, purchase price, value of the business, enterprise value, and then the deal structure. Both of those are ways of understanding risk and quantifying it. So how do you balance those two when you're looking at it with the deals with the buyers?
That's a great question. And so it's actually spot on for Guardian. So what we're working on and we'll be launching in Q1 is, so typically what a buyer will do is assess the business sort of before LOI to put an LOI together. But oftentimes the structure needs to evolve during diligence because there's things that you're learning that you didn't know before. And so when you're thinking about sort of price and then structure, how do I balance?
Mm-hmm.
A couple of things. So price has a lot of pride in it as well. Most of the people who are selling companies are already doing well without the money from the business, particularly when you get to sort of that $10 million level. Do they want the money? Oh, absolutely, they want the money, but they want to go to the country club. They want to tell their neighbors. They want, you know, they want to talk about the multiple they got that was higher. They want to talk about the purchase price that was higher. They want to talk about how they outdid the dude that last had the story that everybody wanted to listen to. And so sometimes you have to give a person a price and then structure down to what you're going to pay them, and that's a compromise, right?
Right. Well, and like just like maybe we can give some examples. We've weaved them in and out, but like, okay, so $10 million, and then you're gonna have, instead of $2 million seller financing, you're gonna have maybe $1 million seller financing and $2 million additional in an earnout based on that large customer. So, and it's so funny you bring that up, Elliot, is like the country club, because like when we say like $10 million valuation, we're always like, here are the next four questions: how many partners did you have? How much debt did you have? And how much did you walk away with? And like, well, 400 grand. Well, they're not going to go
Right.
brag about that at the golf
Yeah,
club.
exactly. Exactly. And so that's the game. The smart deal makers, and I've seen some amazingly smart things done on the buy side that actually solved the problem on the sell side. And both people, I think, won, although if you were in a business school classroom, you may hail the buyer or the seller as the winner. But if it was important enough for one of the parties to negotiate for it in a fairly negotiated transaction, then I think they got it right. So price, that piece. Then there's risk. And so what I was talking about with Guardian, we're coming out with a quality of deal that sort of, in addition to quality of earnings, where you sort of look at a trailing 12 month and last 3 years, what you really need to look at is the next 12 months and next 3 years. Why is that? Because you're kicking the seller out of the company. He's the one who created this thing, knows everything, knows where the buyers are buried. You didn't close any of the customer relationships. You need to understand those, get those. There's a salesperson in there that has them, that if he leaves, that's a lot of risk. You're going to put a lot of debt on the business. So now you need to report on that debt and be cognizant of it. And you are a brand new either manager or advisor in the business you've never created, and none of the employees owe their mortgage, their kids' college, or anything to you. And so the EBITDA you can expect in the next 12 months can be very different than what you expect in the last 12. And how we're going to start communicating that as a quality of deal in addition to quality of earnings, because the risk, to kind of bring it back to your question, the business might be worth 10 million bucks, but I got to pay off my debt with the EBITDA and cash flows coming out of it next 12 months. And I need to prepare for a series of downside things that may occur, because the last thing I want to be doing is going and talking to my banker in the first quarter after I close about why I can't make my payment. So the risk is really around the next 12 months, and the value is about kind of the last, right? There's some interwovenness there, but you have to think about, because you have to win the auction to get the opportunity to buy the business. So you have to sort of pay up to whatever price is going to be the highest price. But then you actually have to live with the business and pay off your investors. And so a lot of times structure is a way to get there.
It's it's so interesting, Elliot. Like, I didn't grow up in this world of finance and like even the schooling that you got. And as I've learned this over the last 7 years, it's like truly I called it on one of my episodes. I can't remember which one. It was like this Venn diagram where you have operations and all these founders who have grown even up to like, you talking, it could be from million to a couple 100 million in revenue.
Sure.
Just owner operator, understand their market, they're competitive. But you're talking about carried interest and general partnership and fund one, fund two, and all these different ways, and like earnouts
Yes.
and employment contract. You just never understood finance, which is
Yeah.
really how the game is played, where you realize that these people are buying companies with other people's money.
Right. Yeah.
And it's just such a huge gap in the market. So when we're going back to the Venn diagram, it's like the owner operators that understand finance too,
Yes.
or the private equity firms who actually understand how to run a company.
Right.
You intersect those, and that's where some insane magic happens.
That's the other thing. You sometimes have to be a little light and humble in this process to be smart. And I'm coming from the school of Charlie Munger and Warren Buffett, because that's kind of where I live. But when we're talking about financial forecasts, let's just be completely honest. We are predicting the future, Ryan.
How'd that work out in 2020, Elliot?
Yeah, yeah, yeah. I know nobody is out here showing off the model they built in December of 2019 for their 2020 expected cash flow, right? So is Ryan better than Elliot at predicting the future through cash? Like you have to have some humility there. The other piece is that there's a lot of things that sort of a buyer can do to screw things up, and that's part of this game too. These guys that are playing these games, not playing this game, these guys that are buying companies with other people's money. It's on some ways it's the most complex financial thing to do. In other ways, it's no more difficult than me buying a mortgage with 30% down, 70% note, knowing that there's going to be, things that are going to come to the community that are going to up my price, and knowing that, in the worst case scenario, I can pay off the $70,000 with some retirement thing. And so my undergrad is engineering, right? And so I got really frustrated when I was at Accenture. To your comment, like people sometimes think, oh, he's a Harvard MBA, he's been in private equity for 10 years, he must have grew up on this. No, I came out of undergrad at Georgia Tech, went to Accenture to do strategy consulting, and the financial stuff came up, and I'm asking, hey, why would you look at return on assets versus return on equity? Why are we looking at net income, versus EBITDA versus operating profit? What's the difference? How do I calculate some of these cash flow improvement projects we were trying to push out in 2008, 2009 during the downturn? And they were like, oh, I can't really explain it to you, Elliot. You need to go to business school for that. And in my head, I'm thinking, I'm an engineer. If there's something mathematical you can't explain to me, somebody is lying.
I love it. It's so true. Right? And by the way, any engineer I've ever come across, they usually deliver me a spreadsheet with pivot tables and VLOOKUPs that I'm not familiar with. So
yes. Yes. And so to that complexity point, I've actually taught some of my friends from Georgia Tech, sort of like an MBA in a weekend to kind of bring them up to speed. Probably similar to what you're doing in your community, right? You have a heart for a certain type of people that, like, look, when you're a scientist and engineer, your understanding and ability to work with numbers is just as strong as any Wall Street banker at the core. The thing is, their language that they have used for their, adult professional life is different than yours. But I tell people all the time, like, finance is addition, subtraction, multiplication, and division. So at a certain point, you can get there if you want to get there. But I think both of us sort of had a process of like this long vocabulary of private equity terms we've been spewing back and forth. And sorry, anybody who doesn't understand them, but like, this is the language of this business.
So when you're going into kind of looping back and about price structure and deal structure, and then how to understand the risk. So let's say you say, okay, you know what? This is a $10 million business.
Right.
It's going to pass the country club ego pride valuation. And it's,
right.
On the surface, good industry, good potential upside. Now, all right, Elliot, I'm hiring you. We're diving into due diligence to see if we can service the debt and I can get the value that I want out of this. Sure. What's the process? How do you go about doing that?
Yeah, so I look at very specific things to understand how those things will affect the expectations for cash flow going forward. So, and I mentioned some of them, but I'll just kind of rattle them off. So, how committed is the seller post-close to your deal? Which is a function of if they're in Johnson, South Carolina, right? And their last name is Johnson, and their cousin is they're probably staying around, and that business being functional is going to be very important to them. You probably have a winner on seller being sort of committed to the outcome of the business. If your guy has on a big diamond pinky ring and has 3 houses in Bermuda, complete opposite, right? And so from a risk perspective and next year's cash flow perspective, you need to recognize that any sort of blip, it's going to be hard to get that guy. If a person all cash offers, you talked about those. Every buyer wants one. Just give me a full cash. Every every seller wants one, every buyer wants 100% earnout, right? And we fight. But if I've got 30% seller financing, I'm way more comfortable that the seller's going to be around to continue. And so that goes into my risk. The other thing that I use to sort of help understand next year's cash flow is how diverse is the customer base? How strong is the value proposition relative to customers? How well perceived are these products or services in the market? The head of sales, who is the head of sales? Is the owner the head of sales, and there's a head of sales that really isn't the head of sales? Or is the head of sales entitled the real head of sales? And that guy, if he's delivering 80% of the revenue, what are the golden parachute things that I put into place to keep him? Because I talked to a guy yesterday who bought a company. He was an acquisition entrepreneur, very smart guy, but it's hard to like think about all the risks. He bought the company. Day 2, the head of sales comes in and says, hey, you're going to boost my salary by 100% and give me a bonus. And you know why? Because otherwise I'm going to take 70% of your business somewhere else. And he had to pay him, right? It was painful, the whole thing. And I don't like considering these sort of messy outcomes, but you ask, how do you deal with sort of next year's risk and calculations? You have to think about what are the 5 or 10 things that could go wrong that would cause you catastrophic risk, and how sure are you that they won't happen? That's essentially it.
What is like the common things that pop up for you? I mean, I've got my own list. I'm just curious from all your experience. What's the short list of things that the gotchas?
Yeah. So first thing is add backs. Every broker seller is going to come with add backs. My favorite to talk about are the absentee owner sellers. And I hear it all the time from like first year looking for deal folks who are like, oh, but the seller says he's absentee, so we're going to add his salary back to the EBITDA and then put a multiple on it. But like, no, he's got a house in Aspen. He spends all his time. He's never at the business. And I keep asking him, so how do you know that? How do you test that? You know, because now we're not just talking about propensity for this guy to be at the company, but we're also talking about a number that you're going to multiply times 5 at our 2 million to 10 million, 5x multiple. And so he has a huge incentive to tell you he's absentee. What else do I see? Working capital challenges. So on smaller deals, call it under $3 million, the seller is going to want to keep the AR. And I don't care what you say. And I don't care what fancy business school hat you want to put on to go tell him that that's not earned revenue that he hasn't received in cash yet. That's what he calls it. He does not call that accounts receivable.
It's cash that's in other people's bank accounts.
He calls that my money.
Yeah.
So I failed on that before. I bring it up because that's issue. What else is an issue? Oftentimes you'll find sort of concentration. The first one is customer concentration, but that's typically sort of handled. The other ones you find is sort of vendor concentration or like employee concentration, like somebody knows too much and now they become sort of mission critical and you got to watch out for them. What else do you find in diligence? Generally, you'll find that the accounting in these businesses is terrible.
We've spun up an entire business this year after our training and our boot camps. People were like, hey, we need some help. And I'm like, you have no one around you that can help you? And they're like, I mean, and literally we get tax returns or just income statements. And people are like, wait, what? 3 statements? What do you mean 3 normalized EBITDA?
And again, I know it because I've worked for family businesses where it took me 9 months to get their QuickBooks in order to be able to go get the financing we needed to go consummate a deal because their stuff was so bad. And it wasn't like the company didn't clear like 25 million in revenue and 5 million in EBITDA. It wasn't lack of resources. They had an accounting firm, but when I talked to them, they were like, we do taxes and that's it. Nobody checks them. So we don't really look at them either. What do you want to know? Now,
did you make any money?
Deciphered, conversation. They don't say it explicitly.
Totally get
it. You go to page 4 of those taxes and ask them the top number, how'd they get there? You see really quick how much work they did. So you have to be comfortable there because you find stuff. You find assets that are either in the business and not on the balance sheet, or sort of on the balance sheet and shouldn't be in the business. You also can find, and this is kind of in the messy sort of this, people play in the downside scenario, people can play a lot of games with inventory and capital expenditures. So when you move inventory around, you think it's just a balance sheet item, but because it affects cash flow, revenue, and cost so much, you really have to be sure that if there's inventory that's material in the business, that you both understand it and you probably should lay eyes on it. CapEx, because, and then Ryan knows as well, and without being audited, the choices you make around, is that a business expense that hits EBITDA, or a balance sheet capitalized expense that doesn't even affect EBITDA? That choice in a business that has, basic level financials can be troublesome, and you need to sort of back up what's right. Those are the areas that I see sort of the most hiccups in.
Well, what's really interesting, Elliot, is, and I want to, because I know we're going to be running short on time here, and is getting back to how you mitigate some of these things with deal structures. But just a comment is like, all of these things, it's just like, as a buyer, you're just trying to understand the story, right? Like, okay, if I want to buy your company, Elliot, like, what kind of guy is Elliot? What kind of leadership team does he have? How is he generating the income and the cash flow? And do we trust him? And then there's all this finance and all these things just to understand the trust that I have in you, so we can transfer this risk and this value. And it's just so crazy because, like, the people that have signed that LOI that want to, hey, how do I do this? It's like, you need years to build that story. Right. And it goes back to your point of like, if it takes a long time to get the data, they're creating the story on the fly because they want their cash all up front. And like, the thing is, you already know it's total bullshit. So let's just call it what it is.
Yeah. Because I've been on the creator of bullshit side too.
Yes. So then, as you're spotting people's, and again, I think there's even like in between here, Elliot, where like they could be telling the truth, but then you go back to, how do I know that? Right. And that's probably the biggest unfortunate situation, which I think you and I are both trying to solve. We're like, you have a good person that wants and is telling the truth, but they didn't do this work to get the value, because you're still saying, I believe you, Ryan, but like, I'm not going to give you an extra $2 million up front. Sorry.
Yeah. And Ryan, so that's where I live. That's where Guardian Due Diligence lives. That's what we do. So how do we mitigate risk? So I calculate risk in sort of two main buckets, like catastrophic, like deal breaker risk, and non-deal breaker risk. And then I think about malicious sort of intent risk, and I couldn't reasonably know risk. And so catastrophic is like if revenue's off 30%, if you're on the rocks with your top 2 customers, if your salesperson just bought a house in another city, if there's an environmental issue under the building, sort of like deal breaker risk. So you go there first, because diligence processes, when they're done right, are structured. And so you knock out the most potentially catastrophic things first, because if you hit a wall at one of those, you stop. So that's the first thing. The other thing you have to mitigate is sort of, so now you have catastrophic. Catastrophic means you stop the deal. Non-catastrophic means you adjust the price or terms. So now you're into the non-catastrophic risk, and there's hundreds. And what you really look at is, like, per each industry, there's probably a set of 10 things that drive, 80% of the sort of fluctuation in business. And so if you're good in the industry, you know which things those are. Guardian's seen so many deals at this point. We know what those 10 things are in most industries. And then there's deal-related 10 things, right, that every deal maker knows. So Guardian, having gone through all of these deals and different people structuring, you sort of put your 10 deal things with the 10 industry things, and non-catastrophic, and now you're sort of through with the kind of, we might not do this deal risk. Now there's sort of this calculation of, because I need to trust sort of the holistic quality of this business as presented by the seller, I need to understand if they said inventory was $1 million and it's really 400,000, Was that somebody who really wanted to be $1 million inventory and paid $1 million for it that hadn't realized it had depreciated to $400,000 and just made a mistake? Or is this sort of the third malicious, purposeful misinformation given? Because the good companies, the data comes quick, the answers are honest. If it's not good, they tell you. And you kind of, to your point, you gain trust. The bad ones, data is slow. People, they have the data because if you're a business owner, you've actually been in QuickBooks, you actually been in your taxes, so there's data available that they're saying they don't have or slow, and then stories start not matching. So it was this reason on day 1, and then day 20, it's some other thing. And I think the way that I learned how to do diligence was kind of amazing because part of it is like the financial stuff. You're in the data room checking those things out. Part of it is, to your point, is I'm going to spend 3 days with Ryan, the seller. And if I come with a notebook and a list of 50 questions, he's going to hate me. And if he hates me, then I don't get the great deal terms. So I remember coming to my first couple of deals with my notebook and my list, and I only want to have 25, so I pulled the 6 and 7 out that weren't as good, and I had my list, and I walked into the seller room, and my mentor would go through a conversation that would last 8 hours. It would sometimes be painful because it felt like it was nothing, but he was an NBA JD and a good poker player. And he was like, I need to see what this guy's eyes look like when he's telling the truth, when he's lying, when he's confident. And the way I do that is I'm asking similar questions, different ways through a long course of time to kind of see what's going on. And it took me a long time to learn how to do that. But that's what you're also trying to see is sort of when you get somebody relaxed, it's almost like, you want to go get the guy a couple of beers and you're hanging out and kind of see what's going on.
It's someone years ago on the show said, you get someone in, everybody can bullshit you for like 3 hours. You can't anything after that. You start to get to the true nature of who people are.
And that's why some of these processes and buyers that keep talking about how efficient they are and how our whole lives are, I don't want to call the guy and sit down with them. I can just Zoom with them because I don't have to travel. Look at the efficiency. I saved $2,000. Mm-hmm. And I'm looking at the 50 and 60-year-old deal people, and they're just like, man, next. Yeah. Right. But people are doing this, and it's like, I don't know. I'm sure in 10 years there'll be somebody here sitting like, here's how you deliver diligence on Zoom, mm-hmm. But right now, you can't get past that. And here's the thing. Even if you don't like some things you find out about the guy, you might not like his political affiliation. I can tell you I've been on the road and that's been the case.
Just a couple of those scenarios in 2020.
Yeah. And long before. I mean, I was looking at deals when Obama was in the presidency and I had to eat 10 minutes of Obama bashing several days in my pursuit. And the business was still great. And I think the seller was still reasonable. He just had a thing he was mad about that day. We all have them. And so you got to sort of manage that. And there's certain things that you can do in person that are really hard to mimic in other ways. And diligence is putting it all together. I don't know if you ever read the book Buyout by Rick Rickerson.
I have not.
Oh.
Ooh, I love it.
One of the best depictions of diligence, and almost anybody I am in a deal with on the buy side has to read, is their chapter called Avoid Deal Hell. That's about diligence. And it tells an elaborate story with all kinds of detail about a young Rick Rickerson and his big private equity firm doing the first deal he was running, going to like Iowa or somewhere to buy a manufacturing company. And if you've been to Iowa and if you've been in a manufacturing facility, you know how the owners look. They are blue collar, jeans, maybe some cowboy boots. Exactly. This guy had a pinky ring and he was like, that's kind of weird. That's off. And he let it slide. And there were 2 or 3 other things that were just off, given like where he was in the business he was in. Right. I think he after drinks with the guy. It was funny that the owner and the controller got on the same car, jumped together to leave. He's like, that's kind of weird. And 2 or 3 other things. And he missed it. and the deal ended up being a bust. And it always comes back to like that pinky ring. So I always talk to people about like, there's nothing wrong with the pinky ring. Like if you're in New York or like Texas, some places, like people are going to have gaudy stuff, but it's like, which one of these things doesn't go with the other one? Like, almost like Sesame Street. Like,
yeah, exactly. Oh, that's a great story.
one of these things is
Not like
not like the other.
exactly. Well, and it's so funny. Like as we could keep going on for a long time, but we'll have to wrap
We
it up.
got to
But
wrap it up. Yeah.
but it's like it's the whole thing of commerce. Like I've gone down this monetary and fiscal policy rabbit hole this year with Ray Dalio and you just name it. And it's just this
Yes.
concept of money that I just freaking
Yes.
love, Elliot. And
Yeah.
all it is a buyer and a seller trying to change
Yes.
hands on an agreed
Yes.
upon value.
That's it.
Period. And the reality
That's
is
it.
we have to trust each other. That's it. And like money
Yes.
is based in
Yes.
trust. The exchange of money
Yes.
is based in
Yes.
trust.
Yes.
And
Yes.
like so due diligence is just a validation of that trust. The people, the deal, the industry, and like all these things are just a way of understanding what that is. And it's so interesting. And I'm curious in your comments on this story that I heard, and I love it, is this one seller who he'll know if he's listening in, is that, all cash offer, very large dollar amount. He just said, I just wanted, everybody says I can ring the bell and I can finally win. And I just looked at him. I said, you're just changing how your net worth is structured. Your company is already worth that. It's just all in one asset. And I said, you're not used to having a huge multi-million-dollar pile of cash. Right now, your company's worth that. Well, what's weird is it's like they think they can get one over on the buyer. Like, dude, like these people are 1,000 times smarter than what's going on. So it's worth what they're willing to pay for it. And so your net worth is already worth that. So there's this big chasm I see, Elliot, and understanding that. I don't know.
There is, and I use analogies a lot. The one that I think is most relevant here is you go buy a car from your neighbor down the street and they say they have perfect details about oil changes, but they don't have the paperwork. They haven't had any engine problems the whole time. They changed the tires. They kept it clean. Most people don't buy it until you take it to your mechanic to check it out. If you're really good, even if you go to the used car lot, unless there's a warranty and the guy says all these kind of things about the car, you still take it to your mechanic to check it out. It's because once that transaction is consummated, there's no take backs. And so the propensity for the person to misrepresent the truth is so high. I talk a lot about sellers at the time of transaction have one of the highest motivations to tell a story, is the way I say it, because each dollar of story gets them 4 to 6 to whatever times that in dollars. And so in that intense environment, you really want to be sure that each dollar is actually true EBITDA, true cash flow. And that's why you come to Guardian Due Diligence, to make sure that you're not buying a lemon.
CarMax, right? I just got done reading Donald Miller's story brand again for the 1,000th time. And it's all about mitigating that issue of trust. Right. I mean, like, how can you understand it? This has been an absolute blast, Elliot. All right. So
this is cool. I have like 3 or 4 emails I need to send you about stuff that we need to talk about, including Ray Dalio.
Oh, yeah.
And
Changing World Order, man. I've read every single freaking word of that. I love it. So 2 questions before we wrap up. One is best place to get in touch with you, Guardian, all the contact, all the other blogs and podcasts that you've been on.
Sure. So guardianduediligence.com. Do is DUE for those who might not be experts. And LinkedIn, Elliot Holland, 2 L's, 2 T's. I'm very responsive there. My email and phone number are on my website, so you can find it there. And if you remember my name more than my business, you can go to elliott-holland.com and find me there too.
Awesome. And then last question is, because of the podcast title, what does the word intentional mean for you?
Planned, allocated time and energy and resources for, executed.
I love it. Elliot, man, this has been an absolute blast. I'm so happy that Tyler introduced us.
Dude, absolutely. I'll send you some emails later on. Have an amazing day.